Temu is everywhere. Scroll through social media and you'll see it. Open YouTube and you'll see it. Watch a sports event and you'll probably see it again. Ultra cheap products, flash deals, free shipping, and prices so low they almost feel unreal. A phone case for $1, shoes for $10, household items cheaper than a cup of coffee. But here's the strange part. Temu is reportedly losing massive amounts of money. So why would a company burn billions just to sell cheap products? To understand that, we need to look at the strategy behind it. Temu is owned by PDD Holdings, a Chinese e-commerce giant that previously built one of the fastest-growing platforms in China. That company proved something important. If you can lower prices enough and make shopping feel like entertainment, people don't just buy, they binge. Temu launched internationally with that exact idea. Instead of positioning itself as a premium marketplace, it went in the opposite direction. It leaned into extreme affordability. The psychology is simple. When prices are extremely low, hesitation disappears. The risk feels small. You're not spending, you're trying, and that changes consumer behavior dramatically. Temu also gamified shopping, limited time offers, countdown timers, spinning reward wheels, referral bonuses. It feels less like traditional shopping and more like a mobile game, and that's intentional. But cheap products alone don't explain the scale of growth. The real fuel behind Temu's rise has been advertising, massive advertising. Temu has spent heavily on digital ads across platforms. Social media feeds are filled with sponsored posts. Influencers promote haul videos. Even large televised events have featured Temu campaigns. That level of exposure costs money, a lot of money. Which brings us to the key question. If they're spending aggressively on ads and selling products at razor-thin margins, where is the profit? The answer might be simple. There isn't much, at least not yet. This is what's often called a market domination strategy. Instead of maximizing profit early, the company focuses on growth, rapid growth, global growth. The logic is long-term. Acquire users now, worry about profitability later. This strategy isn't new. Amazon followed a similar pattern in its early years. For a long time, profitability was secondary to expansion. The company reinvested heavily, built infrastructure, and focused on capturing market share. Temu appears to be using a modern version of that playbook. But there's a difference. Amazon invested heavily in logistics and infrastructure, warehouses, delivery networks, cloud computing. Temu operates differently. Most products on Temu are shipped directly from manufacturers, often in China, straight to the customer. This removes middlemen. It cuts costs. It allows lower pricing. But it also creates longer delivery times and raises concerns about quality control. Temu's model is often described as factory to consumer. Instead of stocking massive warehouses in every country, it connects buyers directly with suppliers. That drastically reduces overhead compared to traditional retail chains. However, it also introduces risk. Long shipping times can frustrate customers. Return processes can be complicated. Quality can vary. And as Temu expands into more markets, it faces regulatory challenges. Trade rules, import taxes, and customs policies can change quickly. If shipping costs increase or tariffs tighten, the ultra-low price model becomes harder to sustain. Another factor is competition. Temu is not entering an empty market. Amazon already dominates many regions. Shein has mastered ultra-fast fashion logistics. Local e-commerce players understand their markets deeply. To compete, Temu must either stay cheaper or offer something different. Right now, the advantage is price, but price advantages can be temporary. If competitors adjust, improve logistics, or apply pressure through partnerships, margins get tighter. There's also the issue of customer loyalty. Many shoppers try Temu because the prices are low. But if prices rise in the future, will those customers stay? That depends on whether Temu can build habit. Habit is powerful. If users open the app daily, browse for fun, and associate it with discovery, switching becomes harder. And that may be the real long-term goal. Not just transactions, but behavioral lock-in. Temu's interface encourages browsing beyond your initial intention. Recommendations are aggressive. Flash sales push urgency. Discounts feel constant. The platform isn't just selling products, it's selling dopamine. And that can drive massive volume. But volume without profitability isn't sustainable forever. At some point, investors expect returns. At some point, ad spending must slow or become efficient enough to pay for itself. This is where the strategy becomes delicate. If Temu pulls back advertising too quickly, growth could stall. If it keeps spending aggressively, losses continue. If it raises prices too soon, users might leave. Balancing those variables is complex. There's also geopolitical risk. As a Chinese-owned platform expanding into Western markets, Temu operates in a politically sensitive environment. Trade tensions, regulatory scrutiny, and data privacy concerns could all affect operations. Even small regulatory changes can have major cost implications at global scale. Then there's reputation. Online marketplaces live and die by trust. If customers repeatedly receive low-quality goods, damaged shipments, or misleading listings, brand perception weakens. And in e-commerce, reputation spreads fast. Reviews matter. Social media matters. Public perception matters. Temu must maintain low prices while gradually improving reliability. That's not easy, because ultra-low prices often mean thin supplier margins. And thin supplier margins can mean compromised quality. So what happens next? There are two realistic scenarios. The first scenario is success. Temu captures massive global market share. Advertising becomes more efficient. Logistics improve. Suppliers scale. The company gradually raises prices slightly without losing users. In that case, early losses were simply an investment. The second scenario is strain. Ad costs stay high. Regulatory pressures increase. Shipping expenses rise. Customers churn when prices adjust. Margins remain too thin. In that case, growth slows and the expansion strategy becomes unsustainable. Right now, Temu stands somewhere in the middle. Rapid growth, aggressive spending, uncertain long-term margins. What makes this story fascinating is that both outcomes are plausible. It could become one of the largest global marketplaces ever built. Or it could prove that extreme discount strategies don't scale indefinitely. The truth is, the model depends on timing. How long can they fund expansion? How quickly can they optimize costs? How patient are investors? Temu isn't just selling cheap products. It's testing a global economic experiment. Can you dominate international retail purely through scale, psychology, and aggressive pricing? We're watching that experiment unfold in real time. And the outcome will likely reshape how global e-commerce competes in the next decade. Because if Temu succeeds, other companies will follow the same blueprint. If it fails, it will serve as a warning. For now, the app keeps growing. The ads keep running. The prices remain unbelievably low. And millions of customers keep tapping Buy Now. The real question isn't whether Temu is losing money. The real question is whether losing money today is the price of winning tomorrow.